is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Service International Limited. Here's your weekly technical analysis of the Chicago soybean complex. I'll start with Chicago soybeans. The influence of, well, let's be frank here, let's be honest here. The influence of the optimized February to October head and shoulders top neckline, currently at 1241, should not be underestimated here. Initially, it had a tempering effect on earlier moves down, but most recently, it had instead become a disrupting effect on the speed of the move lower, even though the neckline itself is bearish. If there is a single incident, okay, let's say there's a couple of incidents that disrupted the move lower and now turned the market back around and started what seems to be a juddering move sideways and occasionally higher, well, I think you can lay one incident definitely at the door of the large combined key reversal up and bullish engulfing pattern made on Tuesday 5 weeks ago. Prices penetrated the overhead 50% Fibonacci line at for the 2019 to May 2021 move at 1229, and later on the 50% Fibonacci line of the April 2020 to May 2021 move at 1243, plus other bearish channel eyes that were valid at the time. However, the next resistance, a dynamic one, proved then and now, as in the last week and this week as well, to be more obstinate. Prices halted and trailed under the slowly declining medium moving average, that's currently at 1278, and that's for the last 4.5 weeks. This is a dynamic resistance to make special note of, as it will shortly become clear. Firstly, though, all this action constructed a major new pattern, one that I had warned about over the last 2 weeks. It was a monthly key reversal down. Now, such patterns are based on longer term actions, so it would not be reasonable to see an immediate move lower in December, which is fortunate, as December has seen a slight pull up to start with and a sideways action since then. However, the action of creating a monthly key reversal down allowed a cleaner view of what is going on here. And what is going on right now seems to be this. Now, I've already mentioned the overhead slowly declining medium moving average capping the market. But now with the slowly declining long moving average currently at 1360 entering the frame from above, there now seems to be the start of a ragged area of support below the 50% Fibonacci line at 1229 that stretched down to the 1180 area. Yet over all of this, there is a new pattern in construction here as well. If we look at the action from October to date, then we have a lopsided diamond pattern. Prices are currently held in between the upper downtrend trend line, currently at 1285. That is just above the medium moving average, and the lower uptrend trend line currently at 1234, which, to be honest, hasn't been tested as yet. These trend lines are not wholly fixed, nor perhaps as yet is the whole pattern, but it does look like a reasonable, if obtuse, explanation of the market's actions, specifically the action around the medium moving average. This pattern expires in early January, unless it is amended, so it will be interesting to see which way the pattern breaks, and if we have any false breaks in the meantime. Chicago soybean meal. The shadow of the monthly key reversal down in May, some 20 weeks ago, has finally seemed to be dispelled. The influence started to break down 5 weeks ago when the market moved up over the short medium moving average, currently at 340.30. And then in the same week up over the medium moving average, currently 343.10. As a heads up, these two look like they might form a golden cross within the next 2 weeks, so watch out, but I digress. Anyway, prices 4 weeks ago punched up over the upper time, currently 345.40 of the key bearish 2021 Andrews pitchfork. However, the move up over the upper time back then could not have come at a worse time, as just above we had then the significant overhead resistance patch made up from the slowly declining long moving average, currently at 368.5, and 50% Fibonacci line of the August 2020 to January 2021 move at 376.70. This halted the attempt higher 4 weeks ago and caused a drop back below the broken upper tine and down to the combination of the medium moving average, the flat lower trendline extension of the broken late June to mid-September descending triangle, currently at 343.20, the nearby very slowly rising short medium moving average, plus the interesting 61.8% absolute Fibonacci line at 336.5, where it held, and then saw a start 2 weeks ago of a fresh attempt higher. Now this move had more energy to it, as prices shot up through all the previous resistances, plus both the key newly attempted resistances of the long moving average and the 50% Fibonacci line at 376.70, closing over both of them last Tuesday, if only just over on the latter. The market halted its rise that day at the middle time, currently 383.60, of the newly drawn October to November bullish Andrews pitchfork. This pitchfork will be one to watch, as the previous 2021 bearish pitchfork is no longer valid and will be retired after this commentary. Finally, the rise also filled in a gap between 375.90 to 378.80 left over from early July. Unfortunately, yesterday's action did not hold altitude, as the market made a counter to the counter bearish harami and closed back below the 50% Fibonacci line, but interestingly right on the long moving average. So far, this still indicates a possible bullish incentive, with the market effectively just coming back down for some fresh ammunition. Now, if that is the case, then we perhaps need to look at the mid-October to date action as a possible bullish halfway hesitation. I haven't marked a target for this on the top side on the daily chart for such an eventuality, but a possible target area would be in the 401 to 402 even area. It all now depends if the market can turn back up from yesterday and try higher towards the middle time. Well, it started to turn up so far today, but it's really not moved that far higher. Chicago soybean oil. For months now, I've highlighted the rather lopsided diamond pattern seen back in May to July. Looking again today, I think the days of its influence are now departing, as other, initially smaller but now more importantly competing patterns have started to become dominant. Now these patterns started with the not so secure overhead medium moving average, currently 59.20, acting as resistance, and recently the congestion zone between 57.64 to 59.44, which you can see as a stripe band across the middle of the daily chart, or my daily chart, along with the rising long moving average, currently at 59.53, that's nearby. Most recently, we've had the support that has turned into resistance of the soft-ish 50% Fibonacci line for the whole of 2021 so far at 55.43, as well as the February 2013 high at 53.96, and finally what is rapidly becoming an important support stroke resistance, the middle time, currently at 54.52, of the mid-October to late November bearish Andrews pitchfork. It is early on this pitchfork, but I'm looking to see if this bearish Andrews pitchfork will indicate the recent bearish angle of attack. Yesterday, the market dropped down to the combination of the lower time, currently at 50.81, of this pitchfork, as well as the March 2013 high at 51.26, and the June 2020 to date uptrend, currently at 51.31. Unlike the November 2020 to date uptrend, which is currently at 51.26, this earlier one has not as yet been optimized. The action this week lays to rest the idea of a very large triple bottom formed over 2021 that I had floated as an idea recently. Actually, I'm quite happy with that, as it was an odd looking combination to start with. Finally, I will retire after this commentary target X2 in the 66.80 area. This was a topside target for the recent descending wedge pattern between July to September. I had previously said on a number of occasions that this was a big ask, and it turned out to be just that. Thank you for listening. This weekly broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.